Good morning. Thanks, Jake, for the kind introduction. I'd like to start with, well, first of all, I hope you all are enjoying today's football-themed program. I'd like to start this morning with a football-themed fraud story. My grandfather meant a lot to me growing up. He had a heart transplant when I was young, and thanks to the good doctors at UPMC Presbyterian, he lived 25 years, more than 25 years after his heart transplant. So he was a formative person in my life growing up, and he did a lot of public speaking after his heart transplant for an organization called TRIO and an organization you're probably all familiar with now, CORE, the Center for Organ Recovery. And over the years, he taught me that anytime you do some public speaking, you should either incorporate some good jokes in your presentation, or you should tell a good story during your presentation. And I saw how Mike's jokes went over, so I'm glad that I opted for the story. And so a little story to share with you this morning. One of my core memories with my grandfather growing up, we spent a lot of good time together. I used to cut his grass. We used to spend time together afterwards. But on once a week during football season, my grandfather would call me, and I was probably 8 years old, and he would go through the football games for the week, and he would tell me who was playing who and what the spread was, and he would ask me who I thought was going to win. And we would do this on a weekly basis, and you know, as an 8-year-old, I didn't quite understand what was happening there, but apparently my picks must have been pretty good, because on several occasions I got some nice gifts from my grandfather, so I'm pretty sure that he put some money in his pocket. Fast forward to today, you know, that was how it worked back then, right? Today we all have very different concept of sports and of participation with fantasy football and things of that nature. And so fast forward today, and of course, like many of the folks in this room, I have a fantasy football team. And my team has been pretty successful over the years, including winning several championships. But I have a confession to make. I do feel like a fantasy football fraud. I spent very little time on my fantasy football team. I do know how to check the scores each week, but I really do very little to manage my team. And you might ask, well, how has your team been so successful if you don't really manage your team? And the answer to that is I learned a lot from my grandfather. You know, he had me make his picks, and I found somebody to manage my football team. And that's my brother, Jeff Wolstoncroft. Some of you might know Jeff. He's sitting over there in the corner of the room. So, Jeff, thank you for managing our fantasy football team, and go Snaggle Schnauzers. Our football theme title today is Playing Prevent Defense. And I struggled a little bit with this title. There were some things about it that I really liked, and there were some things about it that I didn't like. What I really liked about the title is that it really focuses on prevention, which is something that Amber and I will talk about today. And it conveys the importance really of playing defense, which I think is partly what we're doing today too. On the other hand, for the football fans in the room, you know that the concept of playing prevent defense kind of gets a bad rep, right? That's what you play at the end of the game when you're winning, and you're just trying not to give up points. You're okay giving up 5 yards, 10 yards, as long as you're running down the clock, and as long as you're not giving up points, you're happy. But that's different than what we want to achieve, right? As folks responsible for preventing and detecting fraud in our organizations, we really want to prevent and detect fraud not only at the end of the game, And not only the big frauds, but we want to protect against the little frauds throughout the entire game, so to speak. Fraud's something that I've covered from this stage several times over the years. I had some people ask me this morning if this was a how-to guide. It is not a how-to guide, but fraud is not new. Fortunately, we serve a lot of folks in this audience. We know a lot of the folks in this audience. We know that you work for good organizations and organizations that have done a lot to prevent and detect fraud. But I think it's a good reminder every now and then that fraud is real. It's happening all around us. It's happening to organizations that we care about. And we hope that today's presentation serves as a reminder of that for you, and in the interest of continual improvement, might jog some thoughts in your mind about things that you can do to protect against fraud, both in the organizations that you serve in a professional role. But I look around the room, and there's a lot of good folks in this room, and a lot of folks that are involved not only with the organizations that you work for, but with not-for-profits in the community, and encourage you to think about ways you can protect those organizations as well. But fraud is happening all around us. We've all heard news about some of the big and recent frauds, whether that be FTX, whether that be Theranos, both of those hundreds of millions of dollars lost, significant jail time for the perpetrators. It's happening more locally. Earlier this year, the U.S. Department of Labor alleged embezzlement of more than $5 million of pension funds from a local third-party administrator in the Pittsburgh area. Last year, on an even more local level, my family and I live in South Fayette Township, which is just up the road, about 10 minutes. Just last year, I think it was $160,000 was stolen from 2 youth sports organizations. Just up the road in South Fayette. And then I found out just last week that another youth sports organization in our community was under investigation for fraud. So I guess the story is if there's opportunity, people are going to take it, and our responsibility really as leaders in the community with respect to financial matters is to help protect our organizations from that fraud. And fraud prevention, and to borrow from a football analogy, fraud prevention and detection is really what you could refer to as a block and tackle type situation. It's stuff that we have to practice every day. It's stuff that we have to do well at every day. It's stuff that we have to be thoughtful about every day. So again, we hope this presentation is a reminder and serves as an opportunity for you to jog your minds about what we can be doing. With me this morning is Amber Pinskey. Amber is a senior manager in our audit group. She has considerable experience with fraud prevention controls, and as a mother of a youth cheerleader, I think she gets to watch a lot more football than I get to watch. Amber and I will be sharing today's presentation. I'll cover some of the slides. She'll cover some of the slides. We'll bounce back and forth a little bit. We're going to start by looking at the Association of Certified Fraud Examiners 2024 report to the nations. We'll look at some key findings from that report. And interestingly, that report happened essentially during the COVID time period. So there's some good insights relative to the impact of COVID-19 on fraud. And then we'll look at some fraud risk and prevention strategies for a few industries that we know will be relevant to many of the folks in this room. Okay, the 2014 report to the nation is the ACFE's 13th edition of this report. The findings really over time, if you read this report every couple years when it comes out, the findings are remarkably consistent over time. We're going to highlight a few of them, a few of the highlights with respect to COVID-19 changes, because I think this 2024 version is interesting. It includes cases that were investigated between January of 2022 in September of 2023. And since a typical case of fraud lasts about 12 months, that's really in the meat of COVID-19, and so we'll highlight some of the impacts of COVID-19. Without going into too much detail, the study is really quite comprehensive. It covered 1,921 fraud cases from 138 countries, and the total losses associated with those fraud cases was $3.1 billion. So quite a comprehensive study they do every couple of years. The slides we're going to look at next, the next several slides are really graphics directly from the ACFE report. And this first one, this first finding is that CFEs estimate that organizations lose 5% of revenue to fraud each year. And that in and of itself is striking. That's, you know, we're all working hard to show income results to our investors, to our owners. And a lot of us are focused on net income, a lot of us are focused on EBITDA, and a lot of us would love to show a 5% improvement point in EBITDA, right? That would make our businesses look and be much more valuable. But this isn't talking about 5% of net income or 5% of EBITDA. This is talking about 5% of revenue, which is striking. The median loss for case was $145,000 per case, and the average loss was $1.7 million. So the ACFE looks at median as being kind of the normal fraud case. It's noteworthy that 22% of the cases they looked at had losses in excess of $1 million, and when they project these losses over 2022 gross domestic product, the ACFE estimates that more than $5 trillion is lost to fraud each year globally.
All right, so consistent with, is my mic? Okay. Consistent with prior year reports, the report breaks down the fraud, occupational fraud, into 3 different categories. So there's asset misappropriation, financial statement fraud, and corruption. So what they found through their study was that asset misappropriation was by far the most common fraud case. It was present in 89% of the cases examined. However, consistent with prior periods, even though that this is the most common form of fraud, it has the lowest median loss. So the median loss was about $120,000 across those cases. Conversely, financial statement fraud is considered the least common. It was only present in 5% of the cases reviewed, but it is the most costly. So the median loss there was $766,000. And then almost half of all of the cases reviewed had corruption, which had a median loss of $200,000. So really, even though they break it down into these 3 different categories, it's not necessary that you just fall into one category. It was pretty common for there to be fraud covering multiple different categories. The most common overlap was between asset misappropriation and corruption, which was present in 35% of the cases. So since asset misappropriation is the most common type of fraud, we wanted to take a few minutes to just dive a little deeper into the findings there. So when you look at asset misappropriation, you really can look at it in 2 different lenses. So the first would be fraud involving cash, and then the other scenario would be fraud involving inventory and other non-cash assets. So misappropriation of cash can involve theft of cash on hand, theft of cash receipts, and or fraudulent disbursements. So the most common form of cash misappropriation was billing schemes, which was present in 22% of the cases. And so a billing scheme is when a person causes an employer to divert money either by submitting false invoices for fictitious goods or services, or manipulating invoices, or running personal expenditures through the company. So the median loss on the billing schemes cases was $100,000. The most common misappropriation of non-cash assets was found to be theft, and that was present in 22% of the cases. So most common billing schemes and theft of non-cash assets. Now on the other side of the graphic, you can see the most costly was the check and payment tampering, which is another form of fraudulent disbursements. And so that's when a fraudster will intercept, forge, or alter a payment from the company. And the median loss for those cases was $155,000. So I think Mark mentioned this already, but the study found that the typical fraud case will last 12 months before going detected. So that was what was found for the 2024 report and also the 2022. But if you look back to 2020, which is the last time we as a firm presented this, this report to you, it was actually 18 months. So we are seeing a little decline, which means that case fraud is being detected a little more timely. And that's a good thing, right? Because the study also found that the longer the fraud goes undetected, the more costly it's going to be. So to just give you some numbers for perspective, the median loss for fraud detected from between 7 and 12 months was $111,000, compared to over $200,000 if it was detected between 13 and 18 months. So just that 6-month window nearly doubled the loss. If you look out even further, if fraud occurs for 5 years or beyond, the median loss was over $875,000. So it's really important that fraud is detected early. That's why we're spending time this morning to talk about it. But how is fraud actually detected? So the report found that 43% of occupational frauds were detected by tips from whistleblowers. That's more than 3 times more likely than any other detection mechanism. So who are the whistleblowers and how are they reporting these tips? More than half of the tips come from employees and nearly a third come from vendors and customers. Now I just want to pause and say that that statistic shocked me, that there were nearly a third of the tips came from outside the organization. I think that just really highlights the importance to have these mechanisms in place and not only make them available to your employees, but also to outside sources as well, because a third of the cases were detected from reported by outside parties. A few other things that the report noted was that most of the tips were provided through formal reporting, such as like a hotline, and there's a trend, definitely a favor for web-based or email hotlines as opposed to like a telephone. Other detection methods would include internal audit, management review. So combined between the whistleblowers, the internal audits, and management review, that accounted for about 70% of the cases examined. So since we're on the football theme here, I, like Mark, am not going to try to make a joke because I am an accountant and I will own that. But I was thinking as I was preparing about this, just thinking about the hotlines. So I look around the room and I think it's safe to assume that most of us watch football, some maybe more regularly than others. Some maybe have their teams that they follow and watch every game. Some, maybe hit or miss. If they have nothing else going on a Sunday, they might turn the Steeler game on. But I think it's safe to say everyone in this room has at least watched one Steeler game before, or one football game, before. So we are a room full of CPAs bound by a code of ethics. So I would ask each of you to raise your hand if you have ever yelled at the TV for the refs missing a call or a bad call. The people who are not raising their hands are liars. So I was thinking about that, and more recently over the weekend, I'm sure many of you have heard the scandal about Patrick Mahomes, and was he telling the ref to give him a heads up when something was happening? Was he talking to his offensive lineman? What's going on here? I think if the NFL opened a line for us to do a hotline for us to report complaints about the refs, I think they would be overwhelmed by the responses they got. So really just kind of important to have that lines of communication available, and especially to make it available outside the organization as well, not just internally.
The last time, Amber mentioned that the last time we covered fraud at CPE Day was back in 2020, and that year, you may remember that was a year where we did it fully remotely. Megan Troxel and I shared that presentation because it was in the midst of COVID-19. At that time, Megan and I had concerns about the impact of COVID-19 on fraud. Some of the things that we talked about in that presentation were concerns about changes in controls that resulted from shifting from work on site to remote work, changes in controls that might be happening as a result of staffing changes or staffing reductions that were happening at the time. We were concerned about maintaining data privacy and security as we shifted to an online environment. And we were concerned about communication challenges and delays that might result from everybody being remotely. Fortunately, we adapted to a lot of that stuff over time. But as I mentioned, this report includes cases that were investigated right during the height of the pandemic. As you can see here, the median losses increased meaningfully during the pandemic. Financial state fraud was up 29% from $593,000 to $766,000. Corruption was up 33%, and asset misappropriation was up 20%. Amber touched on this a little bit, but it's noteworthy that the median losses were on a downward trend. They had declined from 2016 to 18 to 20 to 22. And the reason that losses were declining is because the time to detection was getting better. The time to detection went from 18 months to 12 months over that period of time. So we were detecting fraud more quickly, which was decreasing the average amount of the fraud. But what happened during COVID-19, we still detected the fraud in an average of 12 months. But the median loss, despite that, increased significantly. And this slide shows, for each of the components, financial statement fraud, corruption, and asset misappropriation. But on average, the median loss increased from $120,000 up to $145,000, which is pretty much the same level as it was in 2016. So essentially, we gave back all of the gains that happened in the COVID-19 period. Hopefully, when we look at this report in 2 years, we'll see that kind of tapers back down. But certainly, there was an impact during that period. The slide here illustrates the median loss for several types of asset misappropriation schemes over the years. Check and payment tampering is in green at the top, and fortunately, my kids wanted me to do the presentation last night, and I'm colorblind, so they told me what colors these lines were. But the check and payment tampering is in, my son told me, light green. The expense reimbursements are in blue. Registered disbursements are in yellow, and cash on hand is in dark green, which I thought was brown. There were increases in the median loss really across the board in 2024, but when we look at this chart, it's really most notably in the check and payment tampering and in the theft of cash on hand. The most costly form of asset misappropriation throughout the years has been and continues to be check and payment tampering. And it also saw the largest increase during COVID-19, which if you think about what would cause that, it might be a function of changes in check stock access. The check stock access may have been a little bit different during the COVID-19 period as it had been in prior periods. And there might have been more use of payment stamps, signature stamps during COVID-19 than there had been previously. There likely was a decreased review of the physical three-way match that had been happening at organizations historically. And so there might have been some subtle changes in internal control that created more opportunity and resulted in more check and payment tampering. And I think also, if we think about the classic fraud triangle, motivation, opportunity, realization, I think if we think about the COVID period, it makes sense that fraud went up during this period. There was almost certainly more opportunity as controls were changing and as we adapted to the pandemic. There probably, for some people was more motivation as a result of financial circumstances during the pandemic. And I think also rationalization probably got easier as we were more disconnected from one another as it became more about less about relationships and more about numbers on a screen. I think it probably became easier to rationalize. This slide lists a number of pandemic-related factors, and the factors include many of the concerns that Megan and I had back in 2020. You can see here organizational staffing changes at the top. You can see shift to remote work. You can see internal control changes. And a number of other things that the ACFE identified as pandemic-related factors. They found that 53% of the cases had at least one pandemic-related factor, and you can see here that many of the cases had more than one pandemic-related factor. I think the lesson that I'd like to take away from this is controls definitely changed during the pandemic. I think there's a lot of good things that we did to adapt. But it's good for us all to think about, hey, what changes have happened over the last 3 or 4 years? And does that impact our vulnerability? And are there things that we can do to tighten things up? So I hope that that's a takeaway from today's presentation.
All right, so this graphic here is from the ACFE report, and it breaks down the cases that they reviewed based on industry. And within each square, which is a green square mark, you'll see on the left, it cites the median losses for the cases examined, and on the bottom right of the square, it shows the number of cases examined. So I wanted to just give everyone an opportunity to look at this, see where your company, your industry falls compared to the others. See if the median loss is what you expected it to be, if it was higher or lower than what you would expect. All right, so of the 1,921 cases examined, the most commonly represented cases in the study were from the banking and financial services and the manufacturing industries. So they represented 305 and 375 cases respectively. However, interestingly enough, the median losses were noticeably greater for the manufacturing industry, which had a median loss of $267,000. So that was the third highest. It fell only behind the mining industry, which had a median loss of $550,000, and wholesale trade, which had a median loss of $361,000. So now that everyone's had an opportunity to see their own industries, we're going to highlight a few here today, and we really wanted to take an opportunity to look a little closer at these industries, what cases were represented in the industries, and what controls can be implemented or refined to help prevent fraud from occurring or to detect it if it does occur. So we will highlight the manufacturing industry, which is noted as one of the most commonly represented industries in the study. Construction, which you will see on the next slide, has a heightened risk across many of the different fraud schemes. We will also focus on the nonprofit industry, which I believe is heavily represented in this room, either from your place of work or your volunteer. And the median loss might be smaller for the nonprofit industries when compared to some of the others, but that doesn't mean that the impact is felt any less. It actually might be more impactful to those organizations. And Mark earlier mentioned many instances of where these nonprofit organizations, these different sports organizations that are experiencing fraud. And then lastly, we wanted to highlight the technology industry. It's kind of in the middle of the pack if you compare it to all of the other industries, but it has some unique risks, which we will discuss shortly. So for each of these industries, we're going to talk about some risks, talk about some controls. These are just examples. It's not meant to be entirely exhaustive. We could spend all day talking about different fraud risks and different internal controls that can be implemented. Also want to give the disclaimer that just because we're talking about the manufacturing industry and you work for tech doesn't mean to zone out, because a lot of these things that we're going to talk about can be applied across different industries. So we kind of just wanted to give that disclaimer at the start. So the report to the nations also included a heat map which depict the occupational fraud schemes across the different industries and how you can kind of interpret that. So this is just a portion of the heat map which we extracted just for purposes of our presentation. You can find the complete heat map in the report to the nations. But really how you can interpret this is if it is a blue shade or a low number, that means that that was the percentage of cases that it appeared for that industry. So that's like, think of good, less risk. As you go to the green, that's going to be more risky, that was more present, and then the red would be, the yellow would be the most present. So obviously the yellow line right across the screen is corruption. So that has the biggest risks, but beyond that, we're going to really dive into some of the others. So we'll start first with the manufacturing industry, and you can see, aside from corruption, which is the most prevalent scheme across all industries, the non-cash and the billing schemes present the greatest risks. So those were at 29 and 27% of the cases. So let's dive in and think about what that really means. Now, before I jump into manufacturing, another football reference to just tie in. So this is, in the football scheme, I was thinking about how my daughter is a cheerleader, Mark mentioned, and as all the parents in the room can attest, when your children sign up for things, it signs you up for things, right? We can't just take the kid, drop them off at cheer, and leave. Somehow we get roped into volunteering. If people find out you're a CPA or an accountant, they really want you to be involved. And so for my daughter's cheer league, every parent needs to volunteer. The most common volunteering event is going to be running the concession stand or being involved somehow in the concession stand. Well, the greatest asset for the league is going to be the inventory they have at the concession stand, right? They spend hundreds of thousands of dollars on the product at the start of the football season. I can tell you from my observations that I witnessed throughout the football season a few different instances where someone who knew the board president did not go in line, went in the back of the concession stand, came out with a handful of candy and chips and everything. Now, I don't know with certainty that they didn't pay for those. I do know they skipped the line if they did, but it is plausible that they walked out without paying for the product. So what's the takeaway here? That there were not good controls in place over the inventory there. So how does that translate to today? Well, we're talking about manufacturing. Obviously, manufacturing inventory is going to be a large asset for manufacturers. It's also going to be a pretty attractive asset for fraudsters to want to look to steal. So practically speaking, inventories are going to be attractive because of the high dollar value, high volume, frequent movement, just makes it easier. The opportunity of the fraud triangle is going to be there. So how can companies mitigate risk? Obviously you can implement physical security, so that might be locking up high dollar value inventory in cages or in separate rooms, requiring, limiting the access to the key to those rooms or the access cards for those rooms. You could also install cameras, not only within the warehouse, but at all exits. So, if someone leaves with a big duffel bag that looked kind of empty when they came in, that might be a cause for concern. Another thing you can do is perform routine physical counts. And to take it a step further, don't just do the physical counts, but analyze any trends. Is there a certain area, a certain team where you notice that there's higher spoilages or more, shrinkage? Is that because of just how they're manufacturing the product, or is it potentially a function of any shrinkage or theft? Another thing would be to monitor scrap. So you think of, we've talked a lot about things that you can walk out with. Well, some inventory is too big to just put in your back pocket and walk out with. But it's still a risk at being misappropriated. So one thing to think about is your scrap. What is your process for monitoring it? Really, it should be from the production line whenever the scrap is first generated, how it's being stored and handled, and then when it is taken and either sold or picked up, if they come pick it up, there should be controls in place in monitoring that. Because scrap can add up over the course of a year, and can be, scrap income can be sizable to a company. Another common scheme of occupational fraud was the billing scheme. So that is when there's a fraudulent disbursement via fictitious invoice or maybe personal purchases being run through the company. So what are ways you can prevent that from occurring? Well, some thoughts we had were to have an approved list of vendors. So that's a list that has been approved. Any changes to the list would have to be monitored, reviewed by another party, by a member of management. You could place restrictions on who has access to modify that list. And don't just focus on the vendor name, but also the vendor address, the payment information, the banking information. Where is that going? Another possible control would be to restrict access to the list of vendors, and also to review the master change logs. So if there is being changes made to the vendor information, is someone reviewing the change log. And finally, you could also actually do a formal review of a vendor listing. So for some of our audits, we will actually do this. We will ask our clients to, someone at executive level, to just review a list of payments by vendor and say, hey, do any of these vendor names pop out, strike you as odd? Maybe it's something you never heard of, or maybe it's a relationship you've terminated, yet somehow there's still being payments made, because that could be a way a perpetrator could disguise fraudulent payments. We could also just make sure you're matching your inventory being received with purchase orders, with invoices, just making sure you have a matching process. So that was the manufacturing industry. The next we wanted to cover was construction. So just looking at this compared to the manufacturing industry and really compared to the others, you'll see a little less blue, a little more green. So a little greater risk in the industry, the construction industry. So a few other risks. 23% of the construction cases involve payroll schemes. So that's going to be a form of fraudulent disbursement when payroll is being manipulated either by virtue of manipulating the hours worked or creating ghost employees. So how could you prevent that from occurring? You could use an automated time system. You could use some form of biometric time system or require an access card, something like that. Obviously, the more controls you have there, so a biometric is harder for someone to manipulate than an access card where someone could pass off. I could give Mark my access card and he could clock in for me, clock out for me, even though I wasn't there. You can also require formal approval of overtime hours by a manager, and the proof of that review should be documented. Now, think about this. Not only is this an opportunity for someone to steal money via falsely reporting their hours, but that's also, in the construction industry, going to impact your bottom line. It's going to impact the job costs, potentially your margin on the job, your revenue recognition, everything. It's going to really have a ripple effect if someone is falsifying the payroll records on a given job. Something else that we do for our audits that is a pretty common practice is we will ask someone of upper level management to review payroll registers. So periodically, it doesn't have to be every payroll register. Maybe it's quarterly, maybe it's twice a year, definitely at the end of the year. Just have an executive scan through the payroll register. Are there any names that jump out at you as being unusual, or any gross pay that seems out of line with what you would have expected someone? Now, obviously, depending on the company size, you have to take that into consideration. So GYF has roughly 100 employees, maybe a few more with our admin. I'm not sure the head count, but I think it would be pretty hard for someone to slip in a fake name without Mark, Jeff, Dawn catching, because we do have such a small group here. But if you have a company with thousands of employees, that's not a reasonable ask, right, to ask the CEO or CFO to review the payroll register. But you could do it on a department level basis, right? Like whoever's the head of the department. Hey, can you scan through this, make sure this jives with your expectations? Just a few thoughts on ways to address that risk. And then also wanted to bring up the expense reimbursements for construction industry, because that was present in 25% of the cases. So similar to payroll, but now we're on the expense reimbursement side. And ways that that could be mitigated would be requiring either the completion of an expense reimbursement form with the receipts, or at a minimum requiring there to be receipts submitted. There could be a formal review process implemented and documented so that the manager is reviewing this, documenting that they approved the expenditure being reimbursed. If the expenditure relates to travel, you could check the dates of the travel. Does that align up with when you understood that person to be out of town? Also to take a look at, not only the dates, but who's the expense reimbursement for? I had a circumstance several years ago where we were looking at an expense reimbursement and noticed that the plane ticket that was reimbursed was for the CEO's wife, who was not an employee at the company. So, that's a situation where that wasn't caught. It was just being reimbursed in probably a circumstance where it shouldn't have been. So just doing those routine reviews, and I think also if people know you're doing the routine reviews, the opportunity is not as great there, so they're more likely to even not commit the fraud that they otherwise would have. So just having the routine reviews and letting people know you're doing the reviews, I think, is a layer of protection. And then my favorite thing to suggest to companies is to use company credit cards. Not only does that help you, you can restrict access, you can restrict credit limits, you can keep it relatively low. If you know someone's going to need a greater limit for travel, you can increase it, but it helps you control the spend a little more. And then also you can have the perks of getting the credit card perks, right? The points, the cash back, the whatever the case may be. And then finally, just wanted to bring up check payment and tampering, because it was present in 19% of the cases for construction industry. And that would be when you intercept, forge, or alter a check or a payment. A few different prevention methods would be like implementing a positive pay system. A lot of banks offer that. Or utilizing automatic drafts for electronic payments for recurring expenditures. So your utilities, things like that, just setting those up for recurring payments. I think we'll have a few more examples of this shortly, so with that, I'll hand it over to Mark.
Thanks, Amber. We're going to finish out our presentation this morning with a few slides on the not-for-profit, and if we have time, on the technology industries too. Referring back to the heat map, we see relatively high when we look at the not-for-profit, which on this slide shows as religious, charitable, or social services. If we look at the heat map there, we can see corruption relatively high at 45%. That includes conflicts of interest and bribery. We see billing at 36%. We see expense reimbursement at 29%. And then, an outlier here is cash on hand. Cash on hand at the not-for-profits being 24% of the cases. We've got, as I mentioned before, I know we have a good group of folks in this room, folks that are dedicated to their jobs, dedicated to their investors, and a lot of folks in this room. I know a lot of folks in our firm. We like to serve our clients. We serve as volunteers at not-for-profit organizations. I'm sure many of the folks in this room do that. As Amber mentioned, once they know you're a CPA or you're financially oriented, they'll ask you to serve on the board or as a treasurer. So I'm confident that many of the folks in this room serve in those kind of roles for various types of not-for-profit organizations, from large and high-profile nonprofits to religious organizations to PTAs to small youth sports organizations. I'm sure that we have many folks that are active in those organizations here. Unfortunately, all too often, those are soft targets for fraud. The slide here suggests segregation of duties for cash handling. And this may be realistic for a lot of the not-for-profits that we audit, that are large enough to require an audit. It's probably realistic to have some segregation of duties. For these smaller nonprofit organizations that many of us are involved in, practically it doesn't happen, right? The treasurers at those organizations are responsible for really all aspects of cash transactions: receipts, expense approval, check writing, general ledger maintenance, bank reconciliations, all kind of under one person. And a lot of those organizations have a high degree of trust in the folks that are serving in those treasurer capacities. If you're on the board, or if you're operating in a treasurer of those kind of organizations, just want to encourage all of us to be thoughtful about that, to think about ways that we can be mitigating fraud risk. I mentioned earlier some of the fraud that has happened locally in my community, and in the baseball association, in the lacrosse association, and now in the football association. I'm the treasurer of our hockey association, and so it's a sensitive point to me. Obviously, getting a lot of questions from folks in the community about what we're doing to prevent fraud. And I think a nice control for a small organization like that, a nice and a realistic control for a small organization like that, and this is something that we do, is yes, I have full control of all of these aspects, whether it be, receipts, approval, check writing, general ledger maintenance, bank reconciliation. So there's risk associated with my position. The way we mitigate that risk is every quarter when I prepare those statements, I also give the bank statements to the president and the vice president of the organization, and I demonstrate for them how does the cash that's reflected in the cash accounts relate to the cash that's reported in the financial statements. And that holds me accountable, because most of the time when folks are stealing from these smaller organizations, they're not reporting it. There's reserve money in the organization, the reserve money gets stolen, but they act like that cash is still on the books of the organization. So if you simply do that simple check, it can really be effective in making sure that somebody beyond the treasurer is verifying that the cash still exists. So I encourage you, please ask your organizations to do that. If you're on the board, ask to see the bank statement and verify that those reserves exist. Slide also addresses interception of cash receipts. And when I think about interception of cash receipts, a lot of our society has gone cashless, and that's helpful from a fraud risk perspective in a lot of ways. But a place that we still see a lot of cash transaction is in religious organizations. And so I was talking earlier with the chair of an audit committee of his church, and I served as the treasurer of my church, so I have a heart for that. If there's opportunity, people will steal money. So if you have cash collections at your place of worship, you really got to have two people responsible for the custody of that cash until it's deposited. And so please make sure you're doing that. Please make sure you're routinely having two people with custody. You're using different count teams, and you're making sure that the folks that are depositing that money, are segregated from the folks that had the custody of that money and that are doing the accounting. Very, very relevant controls, particularly for our places of worship. As I mentioned, a lot of has changed to cashless. A lot of these smaller organizations are using things like PayPal and Venmo to take donations from people. I'd be careful with that too, because in my experience, that's happening. Most of those accounts are personal accounts for these smaller not-for-profit organizations, and there's really no control that what goes into those accounts is what actually makes it into the organization's cash accounts. So again, in our hockey association, we did a fundraiser last year, and we did use PayPal for it because it was convenient. But the control that we implemented there is that I printed the statements from the PayPal account so that our president could see that all the cash that was received into the PayPal account was ultimately transferred into our cash account. So encourage you to use that sort of clarity and transparency. We are just about out of time here. I hope that you found this presentation valuable, just as a refresher that if there's opportunity, people will take advantage of that opportunity, and it's our responsibility to try and protect against that. And there's a lot of good people here, and if we're all exercising that, I think we're going to be in a better place. So, thank you all for your attendance today. Thank you to our clients and contacts in this room, and all that you do to help us be the firm that we are today. And thank you.
Thank you.